Comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Scarlett Fu counting it down to the closing bell, and here to help us take us beyond the bell with a global simulcast. We're joined now by just Tim Stenovic, Carol Master, out this week. Tim, how you doing in there?
I'm doing well. You know, I've had some good visitors in here over the last hour. John Authors from Bloomberg Opinion came by and we had a good chat. Charlie Pellet is in here regularly too. So I got a great crew. I don't want you guys to worry about me at all. Although I will tell you, a lot of our guests have been joining us remotely. I think there's something going around right now. People who were supposed to come into the office and actually be with us on set today, calling in sick, but they're still joining us remotely.
The weather.
Yeah. That too. I mean, more than 2 inches of rain over the last 24 hours here in the New York City area. Hey, we did just have a great conversation with Jay Jacobs.
You said we, Tim.
We, the royal we.
Maybe he and Charlie Pellet did.
Me and myself had a great conversation with Jay Jacobs. I don't want to say I had a great conversation, but I guess I can say I did.
Own it. Come on.
Jay Jacobs. He says that he's over at BlackRock. You guys know him well.
We do.
Handles iShares and just heads up thematic ETFs. Yeah. He's bullish. I don't know if you knew that.
Yeah.
Even though the S&P 500 is up more than 23% so far this year, he thinks that the cash on the sidelines in those money market funds, the $5 trillion, is going to come back in to the market. But he argues for like a disciplined approach here. You know, there's a high bar, he argues, that people are going to need in order to actually make those investments over the next year.
I know we keep talking about this almost $6 trillion that's sitting on the sidelines, but are people definitely are they necessarily going to put some of that money to use right now when all these equity indexes are at or near record highs?
Also, does it belong to the equity market? What about corporate credit? What about treasuries? In any case, you take a look at how we're closing up today as the bells ring. You take a look at the S&P 500 up 0.5%, not quite at a record high. We are a breath or so away, that record high from January 2022, just under 4,800. We'll see if we get that by year end. You take a look at the NASDAQ composite up about 0.6%. And the Dow Jones, of course, this hit a record high last week, but that index, Tim, just about unchanged on the day.
All right, well, peeling back the layers of the S&P 500, you had 293 stocks move higher in the S&P 500, 209 moved lower, 19 stocks on the Dow moved higher. Well, we saw 11, Scarlett, move lower on the day.
Yeah, so definitely an upward bias here in equities. Let's take a look at the sector performances right now. Media and entertainment, that's your Netflix, that's your Meta, boosting that group up by more than 2%. Food and staples, these are retails, names, and they're up by 1.7%. I just checked Costco, continuing to build on recent gains following the special cash dividend that it announced. Retail overall gaining by 1.6%. On the downside, you have tech, hardware, and equipment losing 2/3%. Autos and components down about 0.5%, and banks losing 0.4%.
All right, well, because I'm solo in the radio studio this afternoon, I got the gainers and the decliners.
Wow.
I want to start, no shortage of companies to pick from. We got some interesting and notable moves all around them. I want to start with U.S. Steel. Shares finishing today higher by more than 26%, Katie. Soaring to the highest intraday level, at least since 2011. Some M&A news here moving the stock higher. Nippon Steel agreeing to buy U.S. Steel for $55 a share in cash and an equity value of $14.1 billion, plus the assumption of debt for a total enterprise value of $14.9 billion. We should note that Senator John Fetterman, Democrat of Pennsylvania, he actually vowed to block the deal. He called it, quote, outrageous, and said it's another example of hardworking Americans being blindsided by greedy corporations willing to sell out their communities to serve their shareholders. He said this in a post earlier today, though, so not seeming to move the stock, the regulatory concerns there at least. And then shares of Adobe also finishing the day higher. More M&A news, but this about a deal not actually happening. Shares of Adobe finishing higher by about 2.5%. The company agreeing to walk away from its proposed acquisition of the startup Figma. This coming from regulatory opposition, particularly in the European Union and the UK. It was a $20 billion deal. Adobe's going to pay Figma a $1 billion termination fee. Analysts, though, saw the termination as a positive for Adobe, and Barclays actually upgraded the stock in the wake of that. And let's get over to decliners and talk about Apple. This is a story that I've been obsessed with. I talked about it with you guys last hour, spent some time talking to Charlie Pellet about it. Just checking in on shares at the end of the day, down about 0.8%. This after the company said it's going to be pulling those latest versions of its smartwatch from shelves ahead of the holiday season as a result of this ongoing patent dispute. Shares fell actually at as much as 1.6% earlier in the session. And then SunPower Corp finishing the day down by double digits today. It plunged the most ever intraday, down more than 31%, breached a credit agreement and said there's, quote, substantial doubt about its ability to continue operating. If SunPower's lenders demand immediate repayment, the company wouldn't have enough liquidity to meet its obligations and pay its liabilities, the company said. Quote, as such, substantial doubt exists about the company's ability to continue as a going concern.
You know, you mentioned earlier, Katie, why not corporate credit? That's why.
Yeah.
Why not?
Because of possibilities like that. And
Yeah,
people don't know how to pick winners and losers. They're not doing the homework on every corporate bond.
It's a good point, and definitely something to keep in mind, because the point that we've been talking about is that even though interest rates theoretically coming down next year, they're still super high. And on that note, let's take a look at how the bond market is faring today. You did see a little bit of a sell-off. Of course, the narrative has been this big bond rally that we've seen, especially in the wake of Jerome Powell last week. But a little bit of pushback coming from some of the Fed speakers in the wake of Jerome Powell. That's not really making a dent in the stock market, as we've been discussing, maybe more so in the bond market right now, but we're talking about pretty small moves overall. The 2-year yield up just about a basis point. You go out to the 10-year up about 3 basis points. So nothing major here, but I did want to bring us some of this Fed speak. Of course, John Williams kicked us off on Friday saying that they're not really discussing the timing of rate cuts. That, of course, was one of the big headlines coming out of that press conference on Wednesday. And then Loretta Mester coming just today saying that the financial markets are a little bit ahead when it comes to rate cuts. You think about the Fed's dot plot at 75 basis points of cuts next year, the market at 150 basis points. Maybe that's more than a little bit of a goal.
You know, I was looking at the EcoGo function on the Bloomberg, and you pick central banks on the drop-down menu to see which Fed speakers are coming up to speak. And last week there were only 2. You had Goolsbee, and then you had Bostic speaking again. But they've added a couple more names. Tom Barkin will be speaking tomorrow, and actually Austin Goolsbee will be speaking a couple of times in the next few days. So more opportunity to push back, walk back, talk back to what Jay Powell had indicated on Wednesday.
Yeah, but it seems like markets have decided what they want to do. And Katie, I think you make a good point that the equity market has absolutely ignored any of this so-called pushback. So I'm
because
kind
you're looking for the Santa Claus rowdy.
Exactly. And they're hearing what they want to hear right now. And I think it's really notable that we've had, it hasn't been super forceful, but it's been notable that, Fed speakers have come out and said this, though, Mike McKee making the point over the weekend in a long post on X Twitter, whatever it's called, that I retweeted. You guys should check it out. That talks a little bit about, kind of goes into how Jay Powell answered some questions and said, what these Fed speakers are saying in the wake of this is not that different than the way that he answered some of the questions during the press conference.
But people hear what they want to hear.
Exactly. That's the important point.
And I did see that post. I thought it was really important context. And to the point on the timing of rate cuts, definitely. But it was also the fact that Jerome Powell had multiple opportunities to push back against the easing in financial conditions. It didn't come. And I mean, at this juncture, you think about how far markets have moved. To not push back really seems like endorsement.
Financial conditions, I'm always thinking about this. Are they a reflection of policy, or do they drive policy? It feels like they do both, in which case it's just this circle that goes round and round.
So what are the catalysts that we have between now and the end of the year? We have these Fed speakers who are being completely ignored when they come out and do make comments. But what about corporate earnings and, hearing from FedEx tomorrow or Nike later this week? Does it give us an idea of the consumer? Does it give us an idea of the economy? FedEx certainly will do that. But is it actually anything that moves the needle, Katie?
I mean, you think about, too, some of the real-time data that we're going to get on the strength of the consumer over the holiday period. Of course, all of the travel data as well. But in terms of anything that's really going to alter the course of this rally, of this market, I don't know, you guys.
I mean, there is PCE coming up later this week, and that will certainly be important because that is the measure that the Fed really watches. It's its favorite inflation indicator, but there's a long time between that PCE and, of course, when the Fed speakers really come out in force once again, and when most of the market is back participating again, too. So it could be easy come, easy go.
Wouldn't it be nice, though, if we could all just chill out, just like... Right.
Maybe Fed speakers should come out and say that.
Yeah, guys, just calm down. We'll talk about this in January. Don't worry about it.
Not going to happen.
I don't know.
Not going to happen between now and then. Maybe. I don't know. I think next week is going to be pretty chill.
All right. Well,
I think so.
Tim, we have to leave you now.
I know. Are you worried? Are you worried about me?
You singular.
I'll be okay.
I'm worried about you.
I will be okay. Do not worry about me. Hey, that is going to do it for our Beyond the Bell coverage. Hey, thanks for letting me hang out with you guys on this day when I'm all alone in the studio. Our cross-platform coverage of the market close on Bloomberg TV and radio, Bloomberg Originals, and YouTube. Meantime, catch us tomorrow, same time, same place.